Okay.
All right. So looks like it's Thursday afternoon, 4:15 p.m. Eastern Standard, and we are May 25th, 2023. And we're going to talk with TomLi about the wheel strategy. A little bit of a last minute scheduling item, but happy to have Tom share his expertise as far as low exposure kind of trades, which is really important that we're not just taking those zero DTE, like high risk trades, but we're also adding other types of trades to our repertoire so that we're balancing out what the risk is.
Yeah, this is yeah, I'm happy to jump in and help Eternal cover this hour. The wheel is a shared passion, I think. I set up an account where I show the wheel as well, and
You know what I just realized? I can't, I'm going to try to share your screen, but I don't know if I can. I didn't think about that. So
do you see my screen?
I do, but for my recording, that's where I'm trying to, I need to figure that out. So go ahead and start talking. We're going to try to get something live for people to be able to see. And it might be a weird like half screen view, but I'm gonna work on that in the back end. So go ahead and take off because at least we'll have the audio.
Okay, I'm going to start off and just do a little introduction into the wheel for those that are not familiar with it yet. The wheel strategy is basically a combination of buying shares through selling options and then selling the shares again also through selling options. So let's say you pick a stock like Tesla or like Run or like Roblox, and you like it, and you know that it's volatile, and you know that the option premiums are well, and you don't go and simply buy 100 shares, but you go and sell a put option to collect the premium, let's say for the next 2 weeks, to be a little bit higher than just for this week, and to get quicker assigned than selling the put option for in 4 weeks.
I'm gonna interrupt for just a second. So I've got, well, it's the two squares of death spinning around each other, but the spinning wheel of death on my end as far as visual goes. So I think we maybe need to check in with members and see if they can see what, if you're streaming anything, because I don't have anything showing. So
where would they write it?
And I think there's, I don't know how much screen sharing you've done, but there definitely is. You have to give permission for Discord to allow for the screen share. And this happened when I first, there it is. Got it. Waha. We are good to go.
But you should have it.
Yes. Yep. I've got it now. I can see it. It's beautiful.
Okay. The wheel starts on the top by selling a put. You sell a put with cash in the back. Usually, this is a perfect strategy for people that use an account without margin, because then they can secure the puts with cash. But also you can use it on a margin account. But be aware that if you actually get assigned and have the shares, that you might have to pay for the margin fee.
It went back to the spinning wheel. I'm so sorry. I feel so bad interrupting you. It went back. It's not streaming anymore. There's always tech stuff. And I thought I could, oh, okay. All right. I'm not touching anything on my laptop. We're just going to let this, we're going to let it go. There we go.
Okay. Is it a mistake on my side?
It might be mine, because I was going to go look and see if there were questions on my laptop. So apologies, but I'm not I'll go look at questions from my cell phone.
But you my screen sharing is okay.
Yep, now it's good. So I don't know if I broke it or you did, but one of the two of us broke it. But now it's good, and I'm not touching my laptop until we're done.
Okay. I don't know, where do people usually write their questions? Is
That
it
would
always
be
in
Market Talk. Yeah, that's definitely the best place because that's the premium.
the regular
Mhm.
market talk?
Yep.
Okay.
So I'll go look at those so we can track that. I'm
Yeah,
not used to doing a
I
screen
have
share
my
for someone
phone.
else.
I have my phone in one hand and the iPad in the other.
So here's
Okay,
what I would
so
say is, can you give like in like 15 seconds, why would somebody be interested in the wheel strategy? Because I think some people get overwhelmed by looking at it and it's like more complicated than the naked options positions. So just like really quickly,
so
why would you, what would be your argument for why would you not?
the wheel strategy is basically the perfect tool if you have a stock that you like, but you're not sure if the stock will move upwards, but you're pretty sure that it can move around a lot. So it has a high premium. You can sell the premiums. You might get assigned, so you own the stock. Then you sell the calls again, and you might lose the stock again, the shares again, but you always collect the premium, and you go into the shares and out of the shares as the stock moves up and down, and you always collect the premium. So even if the stock doesn't move upward, you still have the chance to make money on the volatility of the stock and on the movement with the premiums of the sold calls and sold puts.
And so it really helps you
So
buy down what your cost basis is if you're choosing to hold that particular position as far as a commons position, or make up some losses, as the case may be, where we've seen people very frustrated because they bought something and they're like, man, it couldn't go down anymore. But how you hedge against that is the wheel strategy, which is where Eternal has absolutely just rocked over the last 6 months. So that's, yeah.
yeah, the thing is, you have the advantage that you can average down, and just a second,
Now I'm not sure if any of this is secure. So it doesn't look like it's showing any. It shows your user
no,
ID, which is a little concerning. But
no,
okay, just
it's
okay,
just my nickname.
perfect.
So this is the growth project account where I use the wheel strategy. It's a cash account, and I'm holding some of the stocks like Tesla, or for example, Plug. And Plug is a perfect example because I sold $9 put and got assigned, and the stock kept dropping. So I sold another put for $8, and by that I averaged down, and now I have 200 shares, and I started selling calls and work my way back up to the average price of the shares that I got assigned to, and through using the wheel strategy, I can average down my entry price into the shares, and I can profit even if the stock price doesn't move at all, because I can repeatedly sell the covered call, and as soon as my stock price moves above my anticipated target price, I can let myself get called away, and I start all over again by selling the next put.
And called away
And
means the shares have been assigned to somebody else because you're selling that opportunity for them to take them away, which is totally fine. Like
exactly,
that's the anticipation is that you're making the premium, you get to sell the shares, and then it's rinse and repeat.
exactly. And the beautiful thing is, if you have, for example, an account where you have um, 100 shares, 200 shares of a stock that you like, that you want to keep long term, and it dropped a little bit, but you're not concerned about further drops and you want to hold on to it, it's a perfect opportunity to sell uh, some cash secured puts on a lower price basis and start collecting premiums and maybe get assigned on a lower price, and you average your share price down a little bit, and then you just start selling the call on the other side and gets called away on these additional shares again as soon as the stock price goes up.
And
And
so the thing we have to remember is that when we're trading options contracts, it's based on 100 shares. So if you're taking one contract of Tesla, whatever the strike is, it's based on 100 shares. So if you want to sell premium for the wheel strategy or anything else, you have to actually own those 100 shares. And there's some other ways to do that, but thinking I know EK has a couple different positions that he owns like sizable positions in, and he's selling for like 2-3 thousand shares of not Tesla, of course, but some other tickers that are lower cost, that he's got his cost basis down so low that he owns them for free and he continues to make money each month to the tune of like, and I pay attention, but like I'm trying to, like, I'm not EK, so I don't know his exact stats, but it's like $1,500 a month on that one particular position that he already owns for free, that he's selling premium on. That's like, it's free money. And that's the thing that I keep trying to reinforce is, yes, day trading is awesome. That's where I've been making my money lately. However, premium selling is something you definitely, as you build your portfolio, really needs to come into play. So as you're thinking about putting together positions, you have to have 100 shares to be able to sell premium in the wheel strategy. So not for super
and
small accounts, but then that's why we have the other things that you're doing with the 45 DTE and the 1 DTE, and then also what Scovif is doing.
but you actually don't need to do it on the big stocks. You can do it on
Yeah,
smaller stocks as well. I in
exactly.
my example portfolio, I have AMC and Plug. They're
Yeah,
both rather low budget shares, uh,
perfect.
rather low budget stock, but the premium is really nice, and I'm wheeling them because when I look at the 2 weeks option prices, I can make a multiple within the year, and this is where I start to mix up the strategies a little bit. I use I actually use the wheel strategy on my big account usually for as an addition to average my share prices down, and not as a single standing strategy. But you can use it as a single trading strategy if you see that another stock is getting more volatile, because that's where I'm going to come next to is you want to utilize the pure wheel strategy on stocks that are more volatile, that have higher premium prices, and
And they don't have to
if
be the
you
big tech tickers, right? It doesn't have to be Amazon, it doesn't have to be Tesla. It can be things that are smaller. And I
no,
think that's where people there's that unknown of, how much money do I have to do this? And because we've got the different strategies that you guys are really rolling out beautifully, it can be for smaller accounts, it can be for medium-sized accounts, and it can also be for those that hold sizable positions in regular equities that are looking to make some money trading aside what their equity positions are, in addition to what we're doing with options, just as our regular trading day. So it's definitely more overs in the water, which was why I've been so excited about this.
I wanted to show the option chain right now, but somehow my
That happens to me a lot on E-Trade after hours. I've actually been having to use TOS after hours just to see the examples.
Yeah, sometimes it's my internet.
And then sometimes it varies from ticker to ticker as well.
Yeah, now I have it.
Awesome.
There is a point about how to choose the option, the strike price, how to start the wheel, and there are different approaches to the whole thing. For starters, you surely want to get the highest possible premium and make the most money, but maybe you don't want to get assigned for any price, so you might sell the put a little bit lower and be happy with just letting the put expire and sell another put. But if you want to have the share, you might even go in the money and to see how the option price will come to you and how the development over the 1 or 2 weeks or 3 weeks are. You have to watch the deltas and you have to watch the implied volatility.
So can you go into that just very briefly? The deltas, what you'd be looking for if you're watching the deltas. What do you really care about? Start from there.
Yeah, I want to, if I want to have the stock, I want a fast movement on the stock price with every no, I want to, excuse me, if I want the share price at a certain price, I want the option price to move in my direction, and with every move of the stock price, the share price, the option price will change according to the delta. So if the delta is high and the share price goes up or down, it will move accordingly to the delta. And so the closer the option strike is at the money, the quicker the change in the option price will be.
And so what is
the
that
higher
reflect?
the probability of you getting assigned will be. So that's another look at the delta is actually the probability of getting assigned. And if you have a 50 delta, you can also see it as a 50-50 chance to get assigned. If you have a 60 delta, it is a 60% chance that you will get assigned. And
Gotcha.
so this is
that's what I was looking for right there.
Simple and quick. Yes.
So if I'm in something that is like a leap or a long swing, I'm closing things out when we near one, like a 1 delta. And this is different. So we want to be paying attention to what that nuance is, because I think that's where people get confused. Like, where do I sell this? What am I, trying to do with it? And yeah, love it.
The further away from the strike from the stock price, the smaller the delta will be, and the less probable will be that I get assigned. And this is where I have to juggle between: do I want to sell a put just to collect the premium and stay away from getting assigned? Then I choose a lower delta, like for the Iron Condor that I use, I stay below 20. On the put side, it would be below minus 0.2. In this case, some brokers show percentage. E-Trade shows a 0.2 for 20%. In this case, you see the 39 puts for this week have a delta of 28, which is rather low. Actually, it must be rather bullish. But if I go out for June 9th and look at the 39, which is really close at the money, we have a delta of 40. So the probability is pretty high that I get assigned. And the premium is accordingly really high at $1.35. So if I want to get assigned, if I want to have the shares, if I want to start the wheel with selling put and getting assigned, then I will go close at the money, collect the highest premium, and wait until the strike date is passed, and then I will have the 100 shares in my account.
And that's presuming you have the
And then I
money
go
to execute,
on the
right?
other side and look at the calls, and if the stock fluctuates around the price where I sold the put, I will just sell the 39 call again. And let's say the share price stays around 39. I will always have the $2.06 in this case. And even if the share price doesn't move and does nothing for me other than sitting in my port, I still have $2 for the call that I sold, and I still have $1.35 for the put that I sold before. So that's a profit of $3.35, which is almost 10% within 4 weeks probably, because this is now 2 weeks out. And after 2 weeks, I might get assigned, and then I sell the call another 2 weeks out, and I get maybe called away. And this gives me the chance to make, actually, even without any stock movements, a 10% profit within a month. And you can just simply calculate, which means 120% on the year without any stock movement. And if the stock moves again or does its thing up and down, you can even profit on that too. And this is where I want to go a little bit deeper into where I actually look at, because a lot of people just look at delta and at theta. Theta is the Greek that tells me how fast the decay on the sold option goes down. I actually don't even have it on my regular view, because I see it even in my iPad. I don't use my iPad that much. I will pull up another column because I usually look at the extrinsic value, because this is, for me, one of the most important factors of an option is the extrinsic value, because as soon as the extrinsic value goes towards zero, I can be sure that the one buying the option will be interested in either giving me the shares or taking my shares. And before that happens, if I don't want to get rid of the shares, or if I don't want to be assigned, I have to roll my position. Now I have it on the screen. The extrinsic value is the thing that decays over time if the stock price doesn't move. The intrinsic value is the difference between the share price and the strike price in itself. Let's say that the stock price is at 40 and the stock price is at 40 and the strike price is at 39, then there is an intrinsic value of $1 in the option. And the extrinsic value is the additional option premium, which is actually the insurance amount that the option seller takes to cover his risk from losing on the bet. And this extrinsic value is the amount that decays over time through theta. Theta shows the amount of decay every day. The decay happens all day long in a gradual way, so it's not at 12 o'clock the next 10 cents, but it decays over time gradually. And the more extrinsic value the option has, the more profit I can take out of it. And the longer I wait, the more this extrinsic value decays. And now comes the little bonus. The extrinsic value changes the further out of the money and the further in the money the option price is. And with this info, I am playing a lot because I roll my calls rather late as when, for example, the call is in the money by $5, the extrinsic value will be down to, like, if you look at 34 strike price, the extrinsic value is down to 0.27, which is in comparison to the at the money strike price $1.60, very low. And if I roll another month out and at the money again, I get all the extra premium for the additional extrinsic value again, plus the time. And with this, I can make an additional money if I don't want to sell the shares, but roll the covered call from my wheel along with the rising stock price. And this is where I kind of mix between rolling a covered call to extract extrinsic value to profit on decay over time and also on the stock price. And if I have my average down as much as I want and want to get rid of part of my shares, then I just let the option sit and wait until it gets called away.
So for members that are frustrated because they're in trades and they're seeing it like completely evaporate because of theta decay, right? People talk about that, the theta decay. Theta is getting me. Tom and EK benefit from this. So when the people in the naked puts and calls are getting theta clapped, Tom and EK are getting paid. So that's why I'm trying to like promote this as far as there are some alternate strategies if you're finding yourself in 0 day or shorter dated like weekly contracts getting losses over and over again. Why not look at some other things that you could be on the flip side of that, making money when that happens. It's not a bad thing.
For example, with my Tesla, this is the example where I started posting a chart once a month where I show how I rolled around the covered call. I'd keep these 100 shares in this port and just sell covered calls. And actually, I haven't had a single call since beginning of the year that expired worthless because I always rolled. I always let the stock price move by $10, and then I rolled out or I rolled back in, and always played with this time and extrinsic value change. And if you look at this option price here, the cost basis of $28, this is also actually a wonderful hedge on the whole thing, because as soon as the stock price might drop again towards 160 or even 150, um, this option will just crumble to pieces, and will be possible for me again to roll the whole call down and inward. Now this option is for October, so this is rather far out. It's not that bad. And I just wait until the stock price moves past the 190 again, or 100. Usually I even wait until 195 maybe, and I would roll up to the 190 call. Or if it goes down towards the 174, 173, I would roll the covered call also downward and inward in time, and the cost basis can go up again, and it stays rather expensive at the money and gives me the chance to extract more credit. And I just watch how the extrinsic value gets killed by the distance from at the money, because as I showed before, the option price closest at the money has the highest extrinsic value, and the further away from at the money the option price goes, the less value the extrinsic value will have, and the more I profit from this by rolling, because then I can get additional credit. So this is pretty much a 50% hedge for every move downwards. So the last time it moved down to 150 a month ago, I think it was, I collected a total of almost $15 premium, just by rolling down and in and rolling and rolling and rolling. And so this is where I change the wheel actually, and stick to the last part where I just sell the call and I keep my shares. And on the other hand, I also have in this port this plug play where I might keep 100 shares, and the additional 100 shares I will let myself get called away again and sell the next puts, and also will do a mix out of profiting from a hopefully good rising stock price. And if not, then I can profit on the sold put and the wheel. And if the stock price does a jump and I have sold a put and don't get assigned on the put, then I profit on the rising stock price that I have. So this is what I would call a double wheel, because I have 100 shares that I keep, that I could be wheeling, that are stuck in the situation where I just sell the covered call, and another 100 shares that I keep wheeling to add a little bit profit, and profit on the selling put side, because the the point of the wheel is that you can stick to one part of the wheel if you want to. You can stick to selling puts. If you don't want the shares, you can sell the put, roll the put to the next month. If you don't want to get assigned, roll it a couple days before they expire. roll it if the price is too far in the money. Then you can stick to the top part of the wheel and just sell the puts. Never get assigned. Or you can go to the right bottom of the whole thing, get assigned, keep the shares, and start selling the calls. Just sell calls all over again and roll them up and roll them out, and keep the shares. And if you have an account where the tax benefits are better if you keep your shares, then keep selling covered calls and keep a tight leash on where the calls are. Don't let them go too far out of the money. Don't let them go too far in the money. Just roll them tight at the money and profit on decay of extrinsic value. And if I show with the Tesla strategy, I averaged my price just by selling the calls. I started with selling a put for sure, and then by selling the calls, I averaged my price down from $124 to now it's around $70. So it's almost 50% in not even 5 months. And I think this shows exactly what the biggest benefit is of selling calls on shares that you have. And if you want the shares of selling the put before buying the shares by itself.
So two different purposes. You've got yeah, no, it totally makes sense. So we have two different ways, and these are like big basket kind of concepts. We have somebody who wants to hold these in their account, not as long-term equity holds, are okay with the shares being called away, but using the wheel strategy to be able to create some income. And then we have the other category, which is somebody who holds these equity shares in their long-term account, but they're wanting to, maybe the position is moving down and they're wanting to offset some of that price drop, which is really what options were created for, right? That literally what it was created for, as an insurance policy. Yes. So what Tom is talking about is when we're trading 0 day, we're trading weekly, we're trading monthly, naked options. That is not what it's designed for. We have taken it, and I'm going to use the term bastardize. We've literally taken it and done our way with it to change, and it's worked super well for me for many, many years. However, what options are designed for is exactly what Tom's talking about. So if you have an account that has a decent number of shares, whether it's tech stock that you've had for a while, it gives you the opportunity to earn some money. What I would say, one of the biggest questions that I think we would hear and I think I've got a couple questions in market talk, but if let's say you own, I'll use myself for example, hundreds of shares of Tesla from a long time ago, hundreds. I don't want them called away. What would you tell that person? Because there's a lot of people here who own a lot of big tech stocks that don't want them called away, but would be fine with having that be something that creates them some additional revenue. So what would be your strategy if you have somebody who has like 500 shares of Tesla? Nice round number. What would be your suggestion for them to make some money on what they're already holding as the equity as the price moves up and down? Now, looking at your cost basis at 111 a share, I'm guessing you don't want it called away. I'm guessing that's a more recent purchase as we pulled back. But I think for me, I don't want my Tesla shares called away. I don't want the things that I've held in my portfolio for 15 years through up and down. I want to be able to sell premium against them, but I don't want them called away. What's the difference between that and a trading account that you're using the wheel strategy that you're totally fine with? Now you just sold those shares to somebody because you made some money on them.
Yeah, this is really dependent on how much time you want to spend, because there comes the delta again. the probability that you get called away goes up the higher the delta is. And if you have a price, for example, right now it's 184, and you look at the delta just below 20, that's a 202 option strike in 2 weeks. That's almost that's more than 10% upward of the price right now. So the probability is rather low, and before it goes that far in the money that you get called away, it really has to move a lot, and the probability is rather low, and you always can set your alarm at 200 maybe. So if you want a quiet and peaceful option selling, and every 2 or every 4 weeks you want to sell an option, a covered call, then you go down to a delta 15 or delta 12 even, rather far away from your strike price. And you sell it and you wait and you set your alarm, and then you collect this premium every 2 to 4 weeks. Here you have a price for the next 4 weeks at a delta 12, which is at 110, at 210. That's the absolute max we had this year, I think. I don't know how fast it will go there again, but the probability is rather low. And if it goes there, you can roll up anyways. So you just put your alarm at 205 maybe, or at 210, because it still needs to move a little bit past the 210 before somebody will take your shares. And
more importantly, they might not choose to have it executed. So I will say that.
Yes.
They might just be like, oh, I'm just going to let that expire worthless. So there is that.
Yeah, it depends. Usually, if they are in the money, and at the end there's $10 to be made, they will do it. But if it's before the expiration date, there's usually that much extrinsic value in the option. You can see if you go to the 250 strike, there's still a $30 extrinsic value in the option. Usually, nobody will do
Right.
the. Or let's go on the other side. It really doesn't make sense. I'm talking because it will only be executed if it's in the money. But if you go down towards the 150
because it's in the
dollar
money.
strike, for example, there's $2 extrinsic value in this option. This is so much, especially for Tesla. So if you look at the extrinsic value towards the end of your expiration, you will see that it takes a long time until it completely fades away, and you can be pretty sure that you won't get called away if you stay like a little bit outside from the month, from the week, and if you have extrinsic value left. So if you want it relaxed, go a little bit out, go to delta 15, go to delta 12, sell the call every 2 weeks, every 4 weeks, and it will work fine, and you just collect the premium. If you want a better hedge and collect even more premium, then you go at the money. That's what I do with my Tesla showcase here, with the shares that I bought for 111 at the end of last year, and I would actually really go right at the money. If I would start right now, if I would have to start with my first covered call right now. I would go out just 1 week probably, because if I compare 1 week out, I get for the 185, I get almost $5. If I go out 2 weeks, I get just $6.80. So that's just 20% more. It's not that much more, 30% more.
Yeah.
It's not double. So I would go out 1 week, sell the 185, and if the stock price moves in the money, I will roll my covered call out in price, up in price and out in time, and stay at the money all the time, and get the highest extrinsic value from this staying at the money. But this requires watching your stock price and setting your alarms. I just put my alarm at $10 movements, and then I have to watch it and roll and pull out more extrinsic value. So there's two ways. You either can watch it actively and roll around your cover call, or you can stay far away from the present price at a low delta, and you don't even have to watch it that much.
Exactly.
And if you and in any way,
when it's not even watch it, it's you're literally waiting for your alerts.
Selling these.
Yeah. So watching versus what we do with day trading, watching this is like making sure you have an email set up where your triggers send you an email, which is you paid attention. That's not a lot of watching. I love it. That's exactly what I was hoping. Yeah.
And I think I showed my. How can I go into Discord? Can I go into Discord here too? Yeah. I think so. No. I thought I could go into Discord as well.
So what it
No, because it's almost end of the month, so I will make the new chart again. And I could do a filter now for the last 30 days of Tesla rolling. You can see what I collected. 140, 55. There was rather upward move the last 30 days, so there was not that much premium collected, but still within the month. 140, 200, 270, 440, 500, 600, 740, 740, 800, 820, $830 I collected within 30 days just by rolling up and down. And if you look at the bottom, that was the last one was on the drop down to somewhere around 150 at the beginning of May. I rolled down from 160 to 152 call. Here that was even more. That was quite a bit. That was $5 credit. And then we worked a little bit around that price, and then we went up again, 160, 170, and now 180. So I love it when the stock moves. I can roll my covered calls. I can collect premium, even if I don't want to get called away on the regular wheel strategy. I can stay at one part of this wheel and just sell the covered calls and make a lot of money.
And I think that's what people are scared of. If they own those equities, they have the commons position, they're like, no, I don't want to not have it. You can definitely get ahead of it with some like pretty easy like alert setup, which is beautiful. We have a question. And thank you for this wheel strategy stream. Is there an alternative to put selling component for those of us in Canada who are only allowed to buy puts calls or sell covered calls in a retirement account, the RRSP? I'm not in Canada.
Just buy the shares right away. Don't bother with anything else. Just buy the share and start selling covered calls. And don't think about getting the right moment to buy the shares, because it's always wrong. You just buy the shares and start investing, start selling covered calls. Anytime is good as right now. If you want to buy more than 100, like 200, 300, 400, then you can start splitting up into different increments and buy the shares over a period of a couple of weeks, a couple of months. But don't bother. Start with the first 100 shares right now.
And so it all goes back to making sure that you have the shares in place. If you're looking at the wheel strategy, you're not selling them naked. It's completely different than actual, like what we're doing as far as in the alerts channel. I'll have to hold on just a sec.
This is, for example, the second turn of the Oxy wheel. I let myself get called away. Oxy orders. I started. Where did I start? Here it was. I started by selling a put, a 59 put, on May 5th. I got it signed on May 12th. I started selling a call on May 15th, 59 calls for, I got sold with 58 cents. And then I sold another one a week later because the stock price was right underneath the 59. And then a week later on the 26th, no. What do we have now? No, that's the next one again. So on the 19th, I got called away. So I collected within 2 weeks. I collected 2 times premium, and the stock price pretty much didn't move far from the 59 at all. But I collected more than $100 just
nice.
for not-moving stock, and I started selling the next put again. So 3 weeks, collecting $68 each week for a non-moving stock. Wonderful. What else can I?
What else can you ask for? That's, and I'm going to save this for the end, but we had a non-moving that I was like, maybe Tom has some ideas for this. We do have some questions in Market Talk. So going back, Jackie asked, I know you mentioned choosing stocks you don't mind holding, but that aside, how do you choose a stock? Is it based on the IV, the chart, also what's considered a good amount of credit received based on the stock's price? If that makes sense. I'm having a difficult time choosing a decent stock. Also, Do you have a spreadsheet that could be used sharing tracking profits credit with the wheel? We're working on all of the tracking. I will say that. That is a whole nother story, but I think picking things that you want to own is important with the wheel if you're going to sell it in a particular way, how Tom has described.
Yes.
But if you don't want to own it, there's a different strategy. So the question really goes back to, do you want to own this, or are you holding it so you can sell premium and you're fine with it being called away? Completely fine. And those are the two different ones. So like, I don't want my Tesla shares called away because I've had them for a very long time. So I am more proactive with them because I don't want them called away. I want to sell premium, make money on the fact that I own them, as opposed to I'm fine with it. Go, be free, have fun, little shares. And I think that's her question.
Yeah, it's actually a good question because it all comes down to option premium that I'm looking at if I want to spin the wheel. Um, there are some stocks like, for example, Coca-Cola is a perfect example. It's a really nice stock. I wouldn't mind holding it if I want to park my money somehow. But I want volatility and I want the option premiums to be boosted by IV, boosted by liquidity, boosted by market movements. And so I really look a lot at the option premiums um, around the next 2 to 4 weeks. And if IV helps me with, for example, upcoming event like Apple has its info days where the stock usually does some movements that are wilder if something is brought to attention, or earnings is a good example, or even with some market data that is coming. This all can push IV, and the IV price, the IV number is also reflected on the premium. I, the 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 premium price has a movement on IV, as everybody noticed. So if you're on the long side, you want IV to spike during the day, and you profit on it. We do it the other way around. We sell on high IV and profit when IV goes down. So I look at the premium. I look at the IV situation. Is it high or is it low? I prefer a high situation, and I also look at the stock if it is somewhere in the range. If I see a stock that is to my favor in general, but it's in a terrible downward spiral, I would not use it for a wheel strategy. It should be at least in a channel somehow, in a sideward channel, or in an upward trend. Maybe not in a super strong upward trend. Then I would just simply sell puts or own the stock. But if it's somewhere in the channel, moving in frequent waves up and down, it's perfect. And Tesla is the most prominent example, I would say. I love this stock for selling premium. It's perfect.
It definitely is. All right, let me see what else we have as far as questions.
What is RRSP? Is that the Canadian?
Yeah. So Credit Wayne, I am
Okay.
recording it. I just
Yeah.
realized it's actually not, there's nothing on screen that TomLi has been sharing, but at least the audio is there. Just realized it. It was on Discord. It was not in my recording. So trying to figure out like the recording piece of recording Discord, which is a little more complicated, but the audio is there at least.
Yeah.
And the Canadian
So
retirement program is,
I think I pretty much covered the basics. I'm still I just ordered a new webcam microphone thing because I said before that I wanted to start streaming a little bit myself, and I will go through my think process of picking stocks for doing the wheel. I usually try to do it sometimes during the day, not every day, but a couple times a week. And I am happy to share my thought processes, and will show how I look at not only the stock but also on the charts. If I like the stock, not only for the premium but also for the technical analysis, if it fits into the scheme and you don't run into a falling knife, because that can really destroy even your most perfect premium selling.
exactly.
Sheila, you're still there?
I am. Can you hear me?
Yeah, I can hear you
Okay.
now.
Yep. I'm here.
Good.
So I think
Yeah,
those
if
are all of
anybody
our
has any
questions.
question, otherwise I think we can call it a day now.
Yeah, so we've got an hour. It is all only audio recorded because while I thought, I mean, the screen share was good, it didn't show up on my recording. So fingers crossed I can have that figured out. Happy to have been here to at least record the audio. But the important thing is do not sleep on Tom and EK because they are doing some stuff that will change everything for you, especially as you're building your portfolio. So if you're doing well trading 0 days, you're doing well trading, like a smaller account, building it up, don't keep doing that. Take that money and put it somewhere else that's more safe because if you don't, if you keep trading 0 days, weeklies, shorter time frame, you're going to just give it back. And I have not met many people that didn't. So if you're one of them, happy to
Yeah,
hear
just
happy to hear a DM, but let's get that money into investment portfolios using the wheel strategy, spreads, the iron condors, strangles. Like there are other ways to make money with options. And what we're doing in the Analyst Alerts channel primarily is one of them. We use that to build capital and then we put it into other places like equity investments and then deploying these strategies. And this is why Tom and EK are really focused on this right now.
yeah, and Tesla is my most prominent example. Just look at how much premium I keep my shares. I never sell these 100 shares. Because I want to show how fast and how nicely I can average down my share price with every week that the stock is moving up or down. I don't care if it moves up or if it moves down. As long as it moves, if it moves a little bit into my favor, I take it as well for sure. But I sell the covered calls on these 100 shares that I will keep, and I sell and I sell. These are 3 months, and I sell and I collect premium all the time, and it's wonderful. And I think this should be a hint for everybody who has a big port or a small port, whatever stock you're keeping because you like it, because you want to build your investment portfolio, long term portfolio, maybe choose a stock that also has nice premiums to sell. Besides having some smaller stock that you hope that will explode someday into a big one, and sell covered calls and do this wheel strategy to collect additional money.
So what's great about the wheel strategy is it can actually be deployed for things that are considered dividend stocks that a lot of investors really don't care about because there's not price movement. So I'm not, if I buy it, and that was one of the things with Honda that we were looking at today, I was like, this price action is miserable. But if you have dividends off of something and you can do the wheel strategy, you can actually make a decent amount of money with something like this. So this is why I really think it's the whole don't sleep on the wheel. That's it.
Zim is a good example. Just to close the day, Zim is a good example. They have really nice dividends. I have it in the long-term port, and look at the premiums 2 weeks out at the money, almost 50 cents on the put side, more than 50 cents on the call side. And this accumulates during the year, just perfect. In no time you have your price back, and the shares are for free.
And
okay,
that is amazing. When shares are for free is amazing, and you can continue to make money off of them. So that becomes
and collect dividends.
revenue.
Yes.
Yep, revenue producing. It is a business. We're trading as a business. We're not just trading for gambling, for entertainment. It's literally to figure out what the best strategies are for your portfolio so that moving forward, it's not just about like, I can't be at the computer all the time. Maybe you have alerts set up that just trigger like, oh, I hit this level. Maybe I should, I'm going to say this in the most polite way I can. Take a bathroom break, go to the bathroom and execute your trades on your phone because you got the alerts set up ahead of time. If you're working a full-time job, it's still absolutely doable to be able to manage a decent sized portfolio in minutes a day. If you do your work outside of regular trading hours, very, very easy to manage.
I look at my growth port. Actually, I don't even look at it every day. I sometimes look just every 2-3 days, pure interest because I have my alarm set, and I look at it before the week is over. If I want to move something, and besides that, I don't bother with looking at it because I can't help the money grow by looking at it. And
like
I have other things to
water
do.
boil and grass grow. Exactly.
And with the 0 DTE, it's fun, but I need screen time for that. So I just do it if I really have screen time.
Awesome. And so if you guys haven't seen, TomLi is doing 2 different strategies. So he has his 45 DTE. So it's a little longer. You don't have to be in front of a screen all the time. He also has his 1 day to expiration, 1 DTE, that if you really like the faster movement of those positions, but you keep finding yourself like, I love it, but I keep losing money and I don't know how because I don't take the profit as fast as I should, that 1 DTE project is probably for you. It will change your life. If you're, and if you're currently, trading well, you're profitable, maybe that's not for you. Maybe it's something you think about moving down the road. But if you're not executing well and you're like, okay, this is working most of the time, and all of us take losses, that's totally normal. But most of the time you're not net out profitable, you really should be looking at some of these lower risk strategies because TomLi's 1 DTE will give you some eye-opening experiences. And if you're just done with weeklies, dailies, whatever that is, go check out the 45 DTE. because longer dated options are not a bad thing. And I traded a lot of longer dated options as I was starting, but there were only monthly on QQQ. So at the beginning of the month, I was trading monthly at the end, but most of the time I was trading 2 or 3 months out. This is a whole different concept. When we've got the like daily expirations on SPY, QQQ, it's coming soon to have Monday, Wednesday, Friday on things like the big tech. So probably Apple, Tesla, Amazon. I mean, you can add the list up, but they're coming. Do you need to be trading that? If you're not trading it well right now, the answer is no. The answer is you need to be focused on things that can actually be reproducible revenue streams for you for your trading business. And this is the answer.
And if you then get the point that you don't have to hit a home run every time,
Yeah.
if you are happy with 20% or 50%, like I do, for example, I'm a lot of times happy with 20%, and I repeat that and I repeat that, and it adds up. It adds up. Hit a lot of small gains, and
Well, and plus
you
20%
will
is
add
not
up to a big
small
one.
compared to minus 50%, minus 90%. Plus 20% is not small. So we've got to, there are going to be home runs, but we have to move away from that concept of everything's going to be a home run. It's profit that you were not making, that if you stayed in a position that wasn't working well for you was going to be very negative. So it's changing the whole psychology. It's changing the thought process around what you're trading, not just being in those high risk, like crazy, it's either hero or zero, the YOLO concept. 20 to 50% on the stuff that TomLi's doing is reproducible all day long. So with that, I actually have an appointment starting here in a couple of minutes. So I'm going to save this video and I'll upload it and I'll put it in the Theta Gang inside the Bull Trades University. That way we have it, even though there's obviously nothing on my screen as I'm now looking at OBS, but we're at least talking through it and have a good start.
Yeah, and I am pretty sure that we're going to repeat this session at some point, and maybe then I have my YouTube set up as well,
Yeah.
and then we can show some more slides and screen.
Yeah, I think the slides will help. I think it's really confusing for people to look at it. It seems like it's overwhelming. So my suggestion would be if you just listened and you're like, oh, I don't even know what they're talking about, it seems way too complicated, go and literally paper trade everything. Good, bad, indifferent, whatever your thoughts are. Go see how it turns out, what they're doing with the lower cost option strategies, the lower risk option strategies. And you'll be like, oh, that's not that complicated. And you'll start to learn some of the terms. And that's the biggest thing. Do not use real money until you understand it. I don't care what you're trading. Sim trade it, paper trade it. And then as you find the things that for you make sense, you understand why that happened, then you start executing real trades on that, because then your expenses are lower on your education.
And keep your size down if you start using real money. Don't put
tiny.
it all on one bet.
Tiny, 0.5%.
Split it up. Size. Keep your size reasonable small.
And that doesn't mean 20%. That means 0.5%, 1%. Tiny, tiny, tiny. With the keep your powder dry, live to fight another day kind of concept. Because when they are home runs, they are. And you don't have to be in them big because they did what they were supposed to do.
Good. And I'm going to go to bed now.
Right. It's what time is it for you right now?
11:30.
Thank you for hanging out. I know, little different time zone, and like I said, I'm glad I could be here to ask questions and, well, at least record the audio. I'm feeling.
Yeah, if somebody has questions, just send me a message. I will try to help as good as I can.
Well, and I would say not even send a message, like tag him in Market Talk, because the more people are understanding
Yes,
what that is, and I'll have people ask me questions. I'm like, I will definitely answer this, but I think if you're asking me that question, there's 50 other people that have the question that are worried about
exactly.
bothering me. And it doesn't
Yeah, I
bother
like
me.
it when people do it in Market Talk because more people can read it.
The whole idea is the education piece. And so if we can always come back to, we are happy to answer those individual DMs. And if it's something that's for you, that's, maybe private as far as in relation to you, but if it's a general question about what we're doing or what the thoughts are in Market Talk as we're answering it, helps everyone learn. And that's the whole purpose, is everyone learns. And a lot of times, if I answer somebody, I'll just go in and post it like, hey, somebody just asked me the question. I'm going to just recap it here, because if one person is asking that, I'm pretty sure about 50 or 60 or 100 other people are thinking it. They just don't want to bother me. And like I said, it doesn't bother me, but the more we can teach, the better off we are.
The next time when we do such a session, I got a good, a deeper look into the financial data as well, because for the
Awesome.
wheel strategy as well as for the
Oh, you're breaking up just a little bit. So it said for the wheel strategy, looking at financial data, we might have just lost Tom.
you hear me?
I can now.
You hear me? You still hear me?
Yep, I can hear you now.
You hear me?
Yep. Can you hear me? I think we're like
I hear you.
some
I
kind
hear
of,
you.
okay, so you said looking at
You hear me?
at financials. That was the last thing that I
I
heard.
can hear you perfectly.
Well, it sounds like we're having a connection
Yes.
issue between the two of us. I'm going to go ahead and wrap this recording just because I do have to hop off for an appointment. We will definitely pick this up in the next one, hopefully soon.